Alright, welcome back to our third episode of the ICT Building Blocks series. We have already covered fair value and fair value gaps, and initially we covered liquidity, internal and external, and how the market makers move price between those. So today we're going to be going over order blocks, and we're going to be connecting that back to our other lessons, and we're going to be diving a little bit deeper into price action today. So when you're looking for an order block, you want to be seeing something like this. You have your order block form, price return to it, and get propelled lower. In this instance, our order block would be right here. This is exactly how you want to see it, and it's used really often when you're spotting reversals. So what really is an order block? Well, ICT briefly touched on this way back in his Scout Sniper course as well as his Precision Trading Concepts course. He basically described an order block as a point in the market where large hedge funds and large institutions place their giant orders. He says the algorithm will come back and reference that in price action in order to propel price lower. So now I'm going to show you what that looks like visualized on the chart. So your highest probability order blocks are going to be formed near an area of liquidity. So all you're going to be looking for when you're looking for your order blocks is a ranging up close candle like this that is then taken over by a bearish candle like this one here. This white up close candle would then be your bearish order block, and you want to extend that out right in time. Now, as price returns to your bearish order block, you want to take your entry at that opening price, and you don't want to see it go above mean threshold, which is that 50% mark. So taking that same Fibonacci that we created last video in our fair value video, we can apply that to the bodies of our order block. You want to look at your 50% mark, which we're going to be calling mean threshold. And that's where you want to trail your stop. So in this instance, you would take your entry at the opening price of the order block right here. Your stop loss would be just above mean threshold, and you want to be targeting wherever you normally target. In this instance, it looks like we have a measure of sell side liquidity that we should be targeting. You can see that we return to this bearish order block and we send price all the way to and through our sell side liquidity. If we scroll right, we could see this happening one more time. This time it goes to that bottom quarter and sends price lower, so you could take another entry off of this order block again. So this would be your next trade off of the exact same order block. You can see that we come up to that upper quarter and we look for our sell side liquidity resting below the swing low, and you can see the displacement that we get just after this, sending it all the way through our liquidity. And this second trade would offer you 807 ticks. This first trade would offer you 462 ticks of profit. So now we have jumped timeframes to a 4-hour chart, so I'm going to get rid of these drawings we had on the hourly. And you can see this right here. After it is traded through right here on this candle, we can then anticipate this bullish ranging up close candle to act as our bearish order block. So we're going to take the opening price of this up close candle and draw that right out in time. You can see once again price swings down and returns to it, stays below that level that we call mean threshold, and sends price significantly lower. So now we've dropped down to a 15-minute chart in that same area where we saw our 4-hour bearish order block returned to. Now these high time frame order blocks are incredibly useful when you're looking for lower time frame entries when you're day trading or swing trading. So you can see price displaces through this level where we marked out our 4-hour bearish order block and returns to it. When it returns to it, you want to look left for any confluences. Well, we have a lower time frame order block right here in the form of a bearish breaker, and we also have a bearish fair value gap that you guys learned about in our last video. So here's that fair value gap again, just with our 4 quarters marked out as we went over last video. You can see that our bottom quarter of the fair value gap is laid almost exactly on top of our 4-hour bearish order block. So this is where you want to take your entry short. So where is your stop loss in this trade? Well, you just look at this fair value gap, look one candle to the left, and put it above that candle's high. As you can probably expect, we're going to be targeting opposing sell side liquidity that would be resting right here. Now this trade alone is going to offer you 480 ticks, and this is a day trade, not a swing trade. This all comes in the New York AM session. And this just proves to you the power that order blocks hold when you pair them with high probability PD arrays like fair value gaps and liquidity. So now we're going to jump to today's trading, and I'm going to show you the trade I took using all of these concepts we covered in our first 3 episodes. Alright, now we are all signed into Tradeovate looking at today's trading, and you can see exactly where I entered my trade. You can see my initial entry comes as a turtle soup entry, which we briefly went over in our liquidity video. If you're not familiar with what a turtle soup is, all it is an entry model where you're buying when price moves through liquidity and you don't see any reason for it to go higher. The way that is confirmed is by price quickly moving away from your entry. You can see that's exactly what we got right here. We immediately wicked out and began moving lower. We do see one more move higher before displacing significantly lower and leaving behind a fair value gap and a bearish order block. So I'm already short one contract. I see our displacement lower and I see a fair value gap form. Using the lessons I taught you in our second video based around fair value, I took another additional entry here at conjoint encroachment. As you learned today, this becomes our bearish order block, so I take a third entry at this bearish order block, expecting it to send price lower. You can see that's exactly what happened. I took my first partial off right here at our bullish order block, and then I took my second partial off right here below this swing low. After taking liquidity from this swing low, we see one small movement higher before a big down close candle past this bullish up close candle. As you can guess, that is going to be our next bearish order block. At this point, I have trailed my stop all the way in profit above this order block, so I am risk-free on this trade. You can see I take my final profits all the way down here once we're approaching this strong bullish order block we reacted off of in the morning, right inside of our new week opening gap that we inevitably reacted off of one more time. Now you can see this pattern repeating everywhere, just right here, right? We could see that we have a bearish order block formed on this up close candle right here. You could see price returns to its mean threshold before sending it significantly lower. But what does this up close candle here form? Well, that forms another bearish order block, so we can extend that out right in time and anticipate it to go lower once it touches it. You can see that after we touch this bearish order block right here, we sent price lower to and through our internal sell side liquidity. And I really wouldn't mind seeing it come down and filling in this volume imbalance we left in the morning. Now this just goes to show you how powerful these tools and concepts can be once you pair them together to form high probability entries and exits. You can see this trade alone offered me almost 300 ticks of profit, and we are on a 1 minute chart. This did not take long whatsoever. This was about 15 to 20 minutes at the most. Now there is one more tool that I used to take this turtle soup and sell at the high of day. We're going to be covering that next episode, and that is going to be our optimal trade entry, and it's going to be covering premium and discount in these markets and how to find it. Even without your optimal trade entry tool, you are able to take the trade that I just showed you today. In the first video, we went over liquidity. The second video went over fair value, and today we just went over order blocks. Those are the three main ingredients in this trade that offered me about 300 ticks of reward, and it's now something that you are able to do on your own. We're not going to stop here. We're going to continue to add all of these high probability entry techniques and put them all together to form one cohesive entry model that provides extremely high probability trade entries. Next video, we're going to be covering optimal trade entry and how to find premium and discount in a market, to add to your confluences of fair value, liquidity, and order blocks, and adding in that premium, discount, and an equilibrium is going to open an entirely new world of trading for you. It's definitely going to be something to look forward to, but until then, stay safe.